In this video, I'm going to show you my Simply Investing blueprint and walk you through step by step the exact steps you need to take for financial success, including my 12 rules of Simply Investing. But first, I'd like to quickly recap what I've covered in the last 3 videos. In the first video, I talked about how I used to invest in bonds, term deposits, mutual funds, index funds, and ETFs, just like everyone else. But after 10 years, I had nothing to show for it. My investments showed very little growth, no real income growth, and I had paid thousands of dollars in fees. I realized this traditional method of investing was never going to give me financial freedom. There had to be a better way. I spent 3 years researching the best successful investors, learning their methods because I didn't want to reinvent the wheel. Now, everything I learned from those successful investors, plus my more than 20 years of experience as a dividend value investor, I put into the Simply Investing blueprint. My step-by-step guide will show you exactly how to invest, earn more, save time, reduce your risk, and put you on the road to financial success. In the second video, I covered the basics of investing. What is a stock? What is a dividend? And what is the stock market? You learned that a stock represents ownership in a company. And as part owner of a company, you're entitled to share in the profits of the company. And the profits come to you in the form of dividends. In the third video, I shared with you the big secret to achieving financial success by using dividends. In case you haven't watched the first 3 videos yet, make sure you do that right now, because I provide you with practical information to help you on your way to financial success. First, I'll list the 9 major steps in the Simply Investing blueprint. Then I will cover each of the 9 steps in this video. Step 1, I'll cover the 3 investing myths. Step 2, you will see the 12 rules of Simply Investing. Step 3, you'll see how to apply the 12 rules of Simply Investing. Step 4, we will cover the different types of trading accounts. Step 5, you will learn how to build a diversified portfolio of stocks. Step 6, you'll learn when to sell your stocks. Step 7, you will learn how to deal with the 7 main investing risks. Step 8, we will revisit the 3 investing myths from Step 1. Step 9, I will provide you with your action plan for getting started. Let's begin with Step 1. What do most people think of when it comes to investing in stocks? Most people will say that investing is too risky, time-consuming, and it's complicated. Guess what? Investing in stocks is risky, complicated, and time-consuming, if you don't know what you're doing. But when you have the knowledge and understand the basic concepts from this video, you will realize that these 3 statements are in fact not true. I call them the 3 investing myths. By the end of this video, you will understand that investing is not risky, is not complicated, and doesn't take too much time. Don't let these 3 myths hold you back from getting started with investing. Let's move on to Step 2. I designed the 12 rules of Simply Investing to help you earn more, lower your risk, and save you time. These 12 rules are going to help you build a resilient stock portfolio that will provide you with growing passive income regardless of stock prices and what happens in the economy. These rules are designed to minimize your risk and maximize your gains for the long term. These rules make investing easy and simple to implement. A company must pass all the 12 rules before you consider investing in it. These 12 rules are covered in detail with real-life examples in the Simply Investing course. It normally takes about 2.5 hours to cover all the 12 rules in detail. We don't have 2.5 hours in this video. However, because you're watching this now, I will provide you with an overview of each of the 12 rules right now. Let's begin with rule number 1. Do you understand the product or service offered by the company? If you don't, then move on to another stock. You don't need to be an expert in the company, but you should have a general idea of how the company is making money. Rule number 2. Will people still be using this product or service in 20 years? If not, then do not invest in this company. Rule number 3. Does the company have a low-cost, durable, lasting competitive advantage? Let me give you a quick example to help you understand this rule. Coca-Cola operates in over 185 countries worldwide, and the company is 135 years old. It has strong brand recognition all over the world. There are other soft drinks available, but if you want to drink a Coke, there is only one company that can give you that. Even though Coca-Cola spends a lot of money on advertising, if you were to start a company to compete with Coca-Cola today, you would have to spend billions of dollars on marketing, and you still would not get to where Coca-Cola is today as the market leader. Coca-Cola has a low-cost, lasting competitive advantage. Rule number 4. Is the company recession-proof? Let me ask you a question. If there's a recession, or there's a chance you may lose your job, are you going to buy a new car? Of course not. Car manufacturers are not recession-proof, and therefore they should be avoided. So again, in rule number 4, avoid any company that isn't recession-proof. Rule number 5A. The 20-year average EPS growth must be at least 8% or more. EPS stands for earnings per share. Basically, the company's profits. You should only invest in companies that are profitable in the long term. Take a look at the earnings per share for Company A. Over the last 20 years, the earnings have been declining, as you can see in the graph. These types of companies are to be avoided. Take a look at Company B. The earnings are all over the place and unpredictable. In some years, the earnings are even negative. Again, these types of companies are to be avoided. Company C is steadily increasing its earnings over time. These are the types of companies that pass rule number 5A. Remember, the 20-year average EPS growth must be at least 8% or more. In addition to rule number 5A, we also want to make sure in rule number 5B that companies have increased their earnings at least 8 times or more in the last 20 years. Rule number 6. The 20-year average dividend growth must be at least 8% or more. Remember, dividends are cash in your pocket, so you should only invest in companies that increase their dividends over time. Take a look at the dividends per share for Company A. Over the last 20 years, the dividends have been declining, as you can see in the graph. These types of companies are to be avoided. Take a look at Company B. The dividends are all over the place and unpredictable. Again, these types of companies are to be avoided. Company C is steadily increasing its dividends over time. These are the types of companies that pass rule number 6. Remember, the 20-year average dividend growth must be at least 8% or more. Rule number 7. The payout ratio must be at least 75% or less. The payout ratio is simply the dividend per share divided by the earnings per share. In this example, Company A has earned $2.34 per share and has paid a dividend of 98 cents to the shareholders. This is a healthy payout ratio of 42%. The company has room to increase its dividend in the future. On the other hand, Company B earned $2.79 per share but paid a dividend of $3.21 to shareholders. This is not sustainable. The company will have to increase their earnings or most likely will have to cut their dividend. This is why for a company to pass rule number 7, its payout ratio must be 75% or less. Rule number 8, debt must be 70% or less. Take a look at this example. Both companies are in the same industry, have similar earnings and dividends. However, Company A has a debt of 12% and Company B has a debt of 294%. Companies with high debt will have a difficult time surviving a market downturn or recession. In this example, all things considered equal, Company A would be a better investment. Rule number 9. Avoid companies with a recent dividend cut. A dividend increase is a good sign. It means that the company is growing its earnings and is confident in paying a higher dividend to the shareholders. However, a dividend reduction might indicate a problem. Perhaps the company is anticipating a lower profit, meaning the company cannot continue to pay its current dividend. This is a risk we are not willing to take, so it's best to avoid any company that has recently cut its dividend. Rule number 10. Does the company actively buy back its shares? Take a look at this example. Apple had over 20 billion shares outstanding and now has a little over 16 billion shares. When the number of outstanding shares is reduced, the value of the existing shares will increase over time, since there are less shares available, which is typically good news for shareholders. Rule number 11A. The PE ratio must be 25 or less. The PE ratio is the share price divided by the earnings per share. Take a look at this example. Both companies are in the same industry, have similar earnings and dividends. However, Company A has a PE ratio of 15 and Company B has a PE ratio of 175. All things considered equal, Company B is much more expensive than Company A. This is why in rule number 11A, the PE ratio must be 25 or less. Rule number 11B. The stock must be undervalued, or in other words, priced low. Everyone has heard the phrase, buy low and sell high. But how do you know when a stock is priced low? You can easily determine this by looking at the company's dividend yield. A stock is undervalued when its current dividend yield is higher than its 20-year average dividend yield. A stock is overvalued or priced high when its current dividend yield is equal to or less than its 20-year average dividend yield. In this example, you can see that Company A is undervalued or priced low. Therefore, it passes rule number 11B. Rule number 11C. The PB ratio must be 3 or less. This rule compares the stock price to the company's book value. The PB ratio is the share price divided by the book value per share. Take a look at this example. Both companies are in the same industry, have similar earnings and dividends. However, Company A has a PB ratio of 2 and Company B has a PB ratio of 29. All things considered equal, Company B is much more expensive than Company A. This is why in rule number 11C, the PB ratio must be 3 or less. The last rule has nothing to do with looking at financial data, but everything to do with you as the investor. You have to remember to keep your emotions out of investing. The key is to remain patient and disciplined. These 12 rules become your checklist that you need to complete before you invest in any company. Remember, a company must pass all the 12 rules before you invest in it. Let's move on to step 3. The Simply Investing course comes with an easy to fill out Google spreadsheet and a bonus video that shows you step by step how to fill in the sheet, and you will get all the financial data you need from the Simply Investing platform. The Google Sheet will automatically apply for you the Simply Investing rules, numbers 5 to 11C. I call these the SI criteria. Please note that financial data changes all the time. What you see on the screen is sample data and it may not be current when you watch this video. I've already gone ahead and filled in the financial data for all of the stocks. On the screen, you can see 10 sample companies that I'm considering to invest in. Should I invest in all 10 or in just a few of them? The answer is to apply the 12 rules of Simply Investing. As you can see, the 10 SI criteria are listed here and have been automatically applied. If a company fails any of the SI criteria, the spreadsheet automatically highlights the cell and the value is shown in bold. Out of the 10 companies on the list, only 3 of them pass the 10 SI criteria, meaning they pass all of the rules from numbers 5 to 11C. All you need to do now is apply the remaining rules to Walmart, McDonald's, and Johnson & Johnson. Rule number 1. Do you understand the product or services offered by these 3 companies? If you don't, you should remove the company from your list. The remaining 3 companies are household names, and I understand their product and services, so I will leave all 3 on the list for now. Rule number 2. Will people still be using their product or services in 20 years? I believe so. Therefore, I will keep all 3 companies on the list. Rule number 3. Does the company have a low-cost, lasting competitive advantage? These 3 companies are market leaders in their industry, and they have strong brand recognition, so I will leave them on the list. Rule number 4. Are these companies recession-proof? I believe they are, so I will keep them on my list. Remember, rules number 5 to 11C have already been applied for you by the Simply Investing spreadsheet. Don't forget rule number 12 and keep your emotions out of investing. And there you have it. We've applied the 12 rules of Simply Investing and have narrowed the list of stocks from 10 to just 3 companies. If you were going to only invest in one company, I recommend you select the one with the highest dividend yield. In this example, Johnson & Johnson. After you've completed step 3, you need to open a trading account so that you can go ahead and make your first stock purchase. Let's move on to step 4, where I show you the different types of trading accounts available to you. A trading account will allow you to buy and sell stocks. A trading account is similar to a bank account. You can put money into this account or take money out. With the money in the account, you can then buy stocks. Those stocks will remain in your account until you decide to sell them. Dividends are deposited directly into your account as cash. Here's the list of the 7 types of trading accounts available in the US. Each of these trading accounts offers some tax advantages and disadvantages. In some accounts, your dividends and capital gains can grow tax-free. These are discussed in more detail in the Simply Investing course. Remember, tax laws change all the time. Contact your local tax advisor for the most current information. Here's the list of the 6 types of trading accounts available in Canada. Again, each of these trading accounts offers some tax advantages and disadvantages. In some accounts, your dividends and capital gains can grow tax-free. These are discussed in more detail in the Simply Investing course. Remember, tax laws change all the time. Contact your local tax advisor for the most current information. There are pros and cons to each of the trading accounts. Once you've determined the right account for you, the process of opening an account is simple. Then placing a stock order is as easy as paying a bill online. Your discount broker will provide you with instructions on how to use their website or app to place your first order. For your first order, you will need to know which stock to buy, how many shares you want to buy, and at what price. Next, let's take a look at building a diversified portfolio of stocks in step number 5. What's wrong with this portfolio that you see on the screen in front of you? It's made entirely of bank stocks. There is no diversification here. Never put all your eggs in one basket. What happens if the banking sector drops in value, like we saw in 2008 and in 2009? This entire portfolio would be at risk. Diversification helps to reduce the risk to your stock portfolio. In the long term, it's important to build a portfolio of stocks from these 11 sectors. Therefore, if one sector is down, it will not negatively impact your overall portfolio. It's important to know what and when to buy, but it's also important to know when to sell your stocks. And I will cover that in the next step. When should you sell your stocks? Selling is based on many factors, including your own personal situation. Here's 4 main reasons why you may consider selling your shares. Do you need the money? Is the stock overvalued, or in other words, priced high? Is it no longer a quality stock? Is there a better opportunity elsewhere? Let's take a look at these 4 reasons in more detail. Do you need the money? Perhaps you need to spend the money on your child's education, a renovation, new home or car, a vacation, or any other reason. At the end of the day, you are investing so that you can enjoy the fruits of your labor. If you need the money for something that's important to you, then you may consider selling some of your stocks. However, remember the opportunity cost. You will be foregoing any future dividends or capital appreciation for any stocks that you do sell. Is the stock overvalued? A stock is overvalued when its current dividend yield is lower than its average dividend yield. Therefore, if a stock is overvalued, you may want to consider it for sale. Is it no longer a quality stock? A stock may not be a quality stock if it has stopped growing its dividend, is no longer profitable, has increased debt, or has a payout ratio of over 100%. The 12 rules of Simply Investing, which we covered in step 2, can be used as a general guideline. A stock that fails most of the 12 rules may indicate a company that is no longer a quality company. Is there a better opportunity elsewhere? Perhaps you are only earning 0.2% dividend yield on your stock. But you could be earning more than 4% in another undervalued quality stock. Then you may want to consider selling your current shares. Remember, if you have no reason to sell, keep your quality dividend paying stocks that have a history of growing dividends, because those stocks in the long term will put more money in your pocket. Next, let's take a look at the 7 main investing risks that you may encounter during your investing career. As with any investment, there are risks. Let's take a look at the 7 main risks and how to deal with each of them. The goal here is to reduce your overall risk and build a resilient stock portfolio. Risk number 1. The dividend is not guaranteed. It may be reduced or eliminated. The solution here is that you will invest in companies that have a history of paying dividends and a history of growing dividends for many, many decades. Risk number 2. The company may face stiff competition. The solution here is that you will invest in companies that have a lasting competitive advantage, like we saw earlier with the example of Coca-Cola. Risk number 3. Dishonest management and directors. The solution? You will invest in dividend-paying companies because the dividend is yours to keep. It reduces your risk, and once given out, the dividend cannot be taken back from you. Risk number 4. The company may go bankrupt. The solution here is that you will build a diversified portfolio of stocks. Even if 1 or 2 companies in your portfolio go bankrupt, your overall portfolio will not be negatively affected. Risk number 5. Political unrest or governmental policy changes may hurt corporate profits. Solution? You will invest in large international companies, which minimizes the negative effects of policy changes in any single country. Risk number 6. A recession or depression may reduce stock prices. The solution here is that you will invest in quality companies. These companies are better able to survive market downturns. Before you invest, make sure a company passes all the 12 rules of simply investing. Risk number 7, natural disasters. The solution here is that you will invest in international companies and diversify your portfolio of stocks so that a disaster in one location will not affect the company's long-term growth and profitability. In the next step, let's revisit the investing myths. In step 1, I said investing in stocks is risky, complicated, and time-consuming if you don't know what you're doing. But when you have the knowledge and understand the basic concepts from this video, you will realize that these 3 statements are in fact not true. I call them the 3 investing myths. We already covered the 7 main investing risks in step 8. You've seen in step 2 that investing isn't complicated. There are no complex formulas to use. Just apply the 12 rules of simply investing. And in step 3, you saw that applying the 12 rules is like applying a checklist before you invest in any company, thereby saving you time. Now you can see that the simply investing approach is not risky, not complicated, isn't time-consuming. In fact, the simply investing approach saves you time, minimizes your risk, and increases your returns because you are only buying quality stocks when they are priced low. Let's move on to the final step, your action plan to getting started. Here is your action plan to start investing. Open your trading account, determine which stocks to buy, and we saw that in step 3. Build a diversified portfolio, as I showed you in step 5, and become financially independent. These 9 important steps to the Simply Investing Blueprint are covered in detail in the Simply Investing Premium Package, which I will be launching in a few days. The Premium Package will give you the step-by-step blueprint to financial success. But I'm only going to take a handful of new students and teach them my Simply Investing course blueprint. You will learn how to achieve financial success, to no longer waste your hard-earned money on fees, how to generate growing passive income each year, that investing is not like gambling, it isn't complicated, it isn't time-consuming, and you can earn passive income even during a recession. You no longer have to guess how to invest. I'd like to help everyone, but I find that we get the best results when I work with a small group. That way, I can provide all the help and support you really need. So if you're interested, make sure you click on the link under this video and put your name on the early bird waitlist. Everyone on the early bird waitlist will get access to the registration page the night before the premium package launches to the public on February 28th. I hope you enjoyed this video. If you have any questions, send me an email and I'm more than happy to help out. Stay tuned for the next video where I will walk you through a case study of a client of mine. You will see how I saved her over $1.3 million in fees and grew her passive income by 74% in 1 year. See you in the next video.